It is 9:47 a.m. on a Tuesday. Your phone buzzes. You glance down. Breaking news alert. A major money market fund has announced that its net asset value has fallen below $1 per share. The headline uses careful language. Temporary liquidity adjustment, orderly redemption process. But you know what those words mean. The fund broke the buck. Terminal signal 1 just triggered. You have 72 hours before the new rules lock in. This is not a drill. This is not a scenario for next year. In this investigation, I am going to walk you through the exact sequence of the next 72 hours. Not theory, not speculation. Documented playbook based on what happened in 2008, what nearly happened in 2020, and what the game theory tells us must happen when a money market fund fails during a systemic convergence. I am going to show you what breaks hour by hour. I am going to show you what the authorities will do to contain the panic. And I am going to show you what you must do to position yourself before the window closes. Hour zero has begun. The countdown is running. Educational analysis only, not financial advice. Before we start the countdown, you need to understand what just happened. A money market fund is supposed to be the safest investment on earth. It holds short-term debt, treasury bills, commercial paper, certificates of deposit, high-quality liquid assets. And it is supposed to always trade at exactly $1 per share. Always. This is called stable net asset value. You put in $100, you get 100 shares worth $1 each. Tomorrow, next week, next year, still $1 per share. But money market funds are not banks. They do not have FDIC insurance. They do not have access to the Fed's discount window. They are investment vehicles. And if the assets they hold lose value, the share price can drop below $1. When this happens, it is called breaking the buck. The last time it happened was September 2008. Reserve Primary Fund held Lehman Brothers commercial paper. When Lehman filed bankruptcy, the paper became worthless. Reserve Primary's NAV dropped to 97 cents. The fund broke the buck. What happened next is critical. Within 48 hours, investors tried to pull $300 billion out of money market funds across the entire industry. It did not matter if your fund held Lehman paper or not. Panic spread. If one fund can break, all funds can break. Everyone redeemed simultaneously. The Treasury had to step in with an emergency guarantee program to stop the run. That was 2008. The system was under stress, but it was isolated stress. Today, we have convergence. 9 mechanisms are feeding each other. When a money market fund breaks the buck in this environment, it is not an isolated event. It is the trigger for a cascade that moves faster and deeper than anything we have seen before. Let me walk you through the sequence, hour by hour. What breaks, what the authorities do, what you do. This is the playbook. Hour 0 to hour 6, recognition phase. The announcement hits at 9:47 a.m. By 10 a.m., financial news networks are covering it. By 10:30 a.m., the first analysis pieces are published. Is this another reserve primary? By 11 a.m., the Federal Reserve issues a statement. We are monitoring the situation. The financial system remains resilient. We have tools to provide liquidity if needed. The Treasury issues a similar statement. Confidence in money market funds is warranted. We are in communication with regulators. These statements are designed to calm the market. They will fail. Why? Because everyone remembers 2008. Everyone knows that monitoring the situation means they are panicking behind closed doors. The statements create the opposite effect. They confirm the crisis. By hour 3, trading volume in money market funds spikes. Redemption requests flood in, not just from the fund that broke the buck, from all funds. Institutional investors, corporate treasurers, pension funds, they all hit the redeem button simultaneously. The funds try to process redemptions, but they face a problem. They hold 30-day, 60-day, 90-day paper. They cannot sell it instantly without taking losses. If they sell at a discount to raise cash, the NAV drops further. If they do not sell, they cannot meet redemptions. They are trapped. By hour 6, the first fund announces redemption delays. Due to extraordinary circumstances, redemptions will be processed over the next 7 business days. Translation? We do not have the cash. You're stuck. What you do in hour 0 to hour 6. The moment you see the breaking news, you run a liquidity audit. Where is your cash? Bank accounts, brokerage accounts, money market funds, cash management accounts. Make a list. Assume that by hour 48, access to some of these accounts will be restricted. Do not panic. Do not make emotional moves. But verify access. Log into every account. Make sure your passwords work. Make sure 2-factor authentication is set up. Make sure you know how to wire money, how to request checks, how to withdraw cash. Next, communication prep. If you have assets held jointly with a spouse or family member, make sure they know the situation. Make sure they have access credentials. If something happens to you in the next 72 hours, they need to be able to act. Write down account numbers, phone numbers for customer service, wire instructions, store it securely. Do not withdraw large amounts of cash yet. You will draw attention. The goal in hour 0 to hour 6 is information gathering and preparation, not action. Not yet. Hour 6 to hour 24, panic phase. By hour 12, the redemption wave is undeniable. Money market funds hold roughly $6 trillion. If even 10% tries to redeem, that is $600 billion of selling pressure in the commercial paper and short-term treasury market. Prices collapse, yields spike. Corporations that need to roll their commercial paper cannot. The credit market seizes. By hour 15, the Federal Reserve holds an emergency conference call with primary dealers and major banks. The call leaks, rumors spread. The Fed is preparing an emergency lending facility. This creates a secondary panic. If the Fed is preparing emergency measures, the situation must be worse than the official statements suggest. By hour 18, the first bank announces temporary limits on wire transfers. To ensure the safety and security of customer funds, we are implementing enhanced verification procedures for wires over $50,000. Processing time may be extended to 48 hours. Translation: we are running low on reserves. We are slowing down outflows. By hour 24, ATMs start hitting limits. Not official limits, just temporarily unavailable errors. The cash in the machines is running out. Banks have not restocked because they are hoarding currency. Lines form at branches, not full runs yet, but nervous customers withdrawing maximums. 2,000 here, 5,000 there, it adds up fast. What you do in hour 6 to hour 24. This is your action window. You have roughly 18 hours to move before the system starts locking down. Here is the priority sequence. First, verify your positions. If you hold assets at a brokerage, confirm that they are in your name. Are your stocks held in street name or direct registration? If street name, you are a creditor of the brokerage, not the legal owner of the shares. If the brokerage fails, you are in line with other creditors. SIPC insurance covers up to $500,000, but in a systemic crisis, SIPC can be overwhelmed. If possible, request direct registration or transfer to a different custodian. Second, check your bank's reserve position. If you bank with a small regional bank, check their reserve ratios. Are they well capitalized or on the edge? In a crisis, deposits flee small banks for systemically important banks. If you are worried, move deposits to a top 4 bank. They are too big to fail. They will get bailed out. Smaller banks might not. Third, withdraw some cash, not enough to trigger currency transaction reports. Under $10,000 per transaction. Spread it across multiple days if possible. The goal is not to pull everything out. The goal is to have enough physical currency to cover 2 weeks of expenses if electronic systems go down. Rent, food, fuel, essentials. Fourth, test your wire capability. If you have never wired money before, do a small test wire now. Wire $1,000 to another account you control. Make sure the process works. Make sure you understand the forms, the timing, the fees. If you need to move a large amount in hour 36 or hour 48, you do not want to be figuring out the paperwork for the first time. Hour 24 to hour 48, control phase. By hour 30, the Federal Reserve announces an emergency facility. To support the orderly functioning of short-term funding markets, the Federal Reserve is establishing a money market mutual fund liquidity facility. Eligible funds may pledge high-quality assets in exchange for overnight loans. This is QE in disguise. The Fed is printing money to buy the commercial paper that money market funds cannot sell. By hour 36, the Treasury announces an emergency guarantee program. To restore confidence, the Treasury will guarantee the stable $1 NAV of participating money market funds. This guarantee is temporary and will remain in effect until markets stabilize. This is a bailout. Taxpayers are now on the hook for $6 trillion of money market fund risk. By hour 42, the first capital control rumors start spreading. Sources indicate the administration is considering temporary restrictions on large currency transactions to prevent capital flight. No official announcement yet, just leaks, trial balloons. They are testing public reaction. By hour 48, brokerage firms start restricting certain transactions. Due to market volatility, we are temporarily limiting margin borrowing and certain option strategies. Translation: we are reducing our risk exposure. If the system collapses, we do not want to be holding the bag on your leveraged bets. What you do in hour 24 to hour 48. This is the critical decision point. The authorities have shown their hand. They are going to print money and guarantee funds. This tells you the resolution path. They are choosing inflation over deflation. They are choosing bailouts over liquidation. This gives you the strategic framework. If they are printing money, hard assets will rise. If they are guaranteeing funds, moral hazard will explode. If they are restricting transactions, capital controls are coming. Your moves must align with this reality. Evaluate cross-border options. If you have the legal ability to hold assets in a foreign jurisdiction, consider moving a portion now, not for tax evasion, for diversification. If the U.S. implements capital controls, foreign-held assets are harder to seize. Consult with legal and tax professionals. This is not a move to make lightly, but if you have significant assets, jurisdictional diversity is a strategic hedge. Physical security becomes important. If you withdrew cash in hour 6 to hour 24, secure it properly. Not in obvious places, not all in one location. If you hold physical precious metals, verify storage security. In a crisis, theft risk increases. Check alternative access routes. If your primary bank locks down, do you have backup options? Credit union account, brokerage cash management, peer-to-peer payment apps? Redundancy matters. Single points of failure are dangerous. Hour 48 to hour 72, adaptation phase. By hour 54, Congress is in emergency session. They are drafting legislation to formalize the Fed and Treasury interventions. The bill will pass quickly. Bipartisan support. No one wants to be blamed for causing a depression. The bill includes expanded Fed powers, increased FDIC limits, and temporary suspension of certain regulations. By hour 60, the new rules start becoming clear. Banks are required to report large withdrawals. Brokerage firms must freeze accounts with suspected destabilizing trading activity. Precious metals dealers are required to collect customer information for all transactions over $1,000. The surveillance net tightens. By hour 66, black markets start forming. Not physical black markets, digital ones, peer-to-peer crypto trading, offshore accounts, informal lending networks. When official channels restrict access, parallel systems emerge. Prices in these parallel markets diverge from official prices. Arbitrage opportunities appear for those who can access both systems. By hour 72, the new normal is established. Banks are open but restricted. Wires take longer. Cash withdrawals have daily limits. Investment accounts have new rules about what you can buy and sell. The system did not collapse, but it changed. The rules you operated under for the last 40 years are gone. New rules are in place, and if you did not position yourself in the first 48 hours, you are now operating under the new constraints. What you do in hour 48 to hour 72. By this point, the major moves are done. If you did not act in hour 6 to hour 48, your options are now limited, but there are still tactical plays. Understand the new pricing environment. Official prices and real prices have diverged. Money market funds are guaranteed at $1, but if you want to sell commercial paper in the open market, it trades at a discount. Treasuries might show stable prices on your brokerage screen, but bid-ask spreads are wide. Execution is difficult. Learn to read the real market, not the official market. Identify arbitrage opportunities. If you can access both the official system and parallel markets, price discrepancies exist. For example, if gold is trading at one price on COMEX and a different price on offshore platforms, the spread is an opportunity. If corporate bonds are trading at one price through your broker and a different price in private transactions, there is alpha. These windows close quickly. Act fast. Position for the next phase. Hour 72 is not the end. It is the beginning of a new chapter. The bailouts just announced will have consequences. Inflation will accelerate. Currency debasement will continue. Asset prices will be distorted by Fed interventions. Your portfolio needs to reflect this new reality. Hard assets, inflation hedges, jurisdictional diversity, income-producing real assets. The game has changed. Your strategy must change with it. The 72-hour window addresses the immediate crisis, but the immediate crisis is just the first domino. Let me show you what breaks next. Week 2, corporate credit seizure. Corporations rely on commercial paper to fund operations. With money market funds in crisis and the Fed buying selectively, many corporations cannot roll their debt. They draw down credit lines. Banks face a wave of drawdowns. Bank reserves drain. The repo market freezes again. This accelerates the conversions we mapped in video 10. The feedback loops intensify. Week 3, pension fund liquidations. Pension funds hold money market funds as their cash allocation. When those funds froze redemptions during hour 6 to hour 24, pension funds could not access cash to meet obligations. They are forced to sell other assets, stocks, bonds, real estate. Forced selling drives prices down. This triggers margin calls on leveraged positions. More selling. The doom loop accelerates. Week 4, insurance company runs. Insurance companies hold commercial paper and money market funds. The crisis hits their asset side. Policyholders notice. They request withdrawals from annuities and cash value life insurance. The redemption wave spreads from money markets to insurance. State regulators step in. They freeze withdrawals. They impose surrender penalties. But the damage is done. Confidence in the insurance sector collapses. Month 2, international contagion. The crisis started in U.S. money markets. But money market funds are global. European funds hold U.S. commercial paper. Asian funds hold U.S. treasuries. When the Fed prints money to bail out U.S. funds, the dollar weakens. Foreign holders of dollar assets take losses. They sell. This dumps more treasuries and commercial paper onto the market. The Fed has to print more to absorb the selling. The doom loop goes global. This is why 72 hours matters. The actions you take in the first 72 hours determine whether you are positioned for the cascade or caught in it. Let me be direct about the cost of hesitation. If you wait until hour 48 to act, you face restrictions that did not exist in hour 6. If you wait until week 2, you face capital controls that did not exist in hour 48. The window closes fast, and once it closes, your options are limited. Access loss. In hour 6, you can wire money freely. In hour 48, wires are delayed. In week 2, wires over certain amounts require approval. Each phase adds friction. Early movers have liquidity. Late movers are trapped. Optionality loss. In hour 6, you can choose where to move assets. Different banks, different brokerages, different jurisdictions. In hour 48, some of those options are restricted. In week 2, cross-border transfers are flagged. In month 2, they might be blocked entirely. Early movers preserve choice. Late movers face constraints. Pricing loss. In hour 6, markets are chaotic but functional. You can transact at market prices. In hour 48, bid-ask spreads widen. Execution becomes difficult. In week 2, some assets have no bids at all. You cannot sell at any price. Early movers get market prices. Late movers get distressed prices or no price at all. Security loss. In hour 6, withdrawing $5,000 in cash is routine. In hour 48, it might trigger a currency transaction report. In week 2, it might trigger an investigation. In month 2, it might be denied. Early movers secure resources quietly. Late movers draw attention. The 72-hour window is not arbitrary. It is the period before the new rules lock in, before the surveillance intensifies, before the controls tighten. Miss the window and you're playing a different game with different rules. We have walked through the 72-hour countdown, from the breaking news alert at 9:47 a.m. to the new normal at hour 72. You now have the playbook. You know what breaks, you know what the authorities will do, you know what you need to do. But here's the reality. 72 hours is not a lot of time. If you wait for perfect information, you will miss the window. If you wait for official confirmation, the window will already be closed. The actions that matter happen in the chaos of hour 6 to hour 48. When information is incomplete, when fear is high, when everyone else is paralyzed by uncertainty. This is why preparation matters. You cannot execute a 72-hour playbook if you are learning the moves for the first time under pressure. You need to have already run the audit. You need to have already tested the wire process. You need to have already identified your backup options. When hour 0 begins, execution should be mechanical, not emotional. Here are the 3 immediate actions you can take today, right now, before any crisis hits. Action 1, run the liquidity audit. Make a spreadsheet. List every account: bank, brokerage, retirement, cash management, money market. List the institution name, account number, balance, and access method. Verify you can log in. Verify you have the customer service numbers. This takes 30 minutes. Do it today. Action 2, test a small transaction. Wire $1,000 from your bank to your brokerage, or vice versa. Experience the process, learn the friction points, time how long it takes, note the fees. If you have never done this, you need to do it once in a calm environment before you try to do it in a crisis. Action 3, identify your backup systems. If your primary bank freezes, where do you go? If your primary brokerage restricts transactions, what is your alternative? Write down 3 backup options for each critical function: banking, brokerage, payment, currency access. Redundancy is your insurance policy. The 72-hour countdown is not a distant scenario. It is the documented sequence from 2008, nearly repeated in 2020, and inevitable in the convergence environment we mapped in videos 1 through 10. The trigger can be a money market fund. It can be a bank failure. It can be a sovereign default. The specific trigger does not matter. The cascade is the same, and the 72-hour window is the same. The question is not if the countdown begins. The question is whether you are ready when it does. In the next video, we are going to answer the question you're asking right now. Okay, I move fast in the 72 hours, but where did I move the assets? Video 12 is the asset relocation matrix, not generic advice, specific framework, asset type by jurisdiction, by risk profile, what goes where, what stays liquid, what gets locked down, the playbook for hour 73 and beyond. The countdown has started in this scenario, but in reality, you still have time. Use it. Stay prepared. And remember, in a crisis, speed is a strategy. The first movers have options. The last movers have regrets.